We're starting to see some weakness coming to the fore. The rand looking slightly better in today's session. Oil prices reaching above $100 a barrel. Concerns in Egypt. We've got equity markets rebounding. What exactly is going on with the currency market at this point?
Good morning, Eleni. Well, yes, absolutely. The rand has been weakening in accordance with the broad-based risk aversion that we've seen as a result of the geopolitical tensions flaring up in Egypt. And I think, although the rand, as you mentioned quite rightly, has stopped weakening, I think the risk is that it's going to weaken a bit further if these geopolitical tensions obviously intensify. So everyone's still watching the Egypt story very, very closely to see developments there, because if risk aversion continues to intensify, then I think emerging markets, commodities, as well as your equity markets are probably going to take a little bit of a correction.
Well, Michael, that coupled with a very strong bond outflow since the beginning of the year to the tune of around 15 billion rand, and the fact that the Reserve Bank is accumulating reserves as well, what does that spell for the local currency?
Well, that's why we've been quite bearish about the rand. During the first half of this year, we've expected some of those bond flows to intensify, mainly because the interest rate cutting cycle is a thing of the past. We also think that bond supply is going to be increasing going forward. You couple that with the Reserve Bank, which has clearly become a lot more active. We'll see probably confirmation of that in a couple of days when they release the reserves figures. But those two, combined with this risk aversion that we've seen playing out in Egypt, doesn't bode well for the rand, and I think, as I say, the risk is that we weaken further from here.
Let's touch on some economic data. We had the trade balance out yesterday, surplus of 10.3 billion rand. Most were expecting around 3 to 4 billion, and those were the bullish people out there as well. Michael, looking at the fact that we saw very strong vehicle exports during that month, it perhaps shows that we shouldn't be putting too much focus on a very strong rand. Your view?
Well, it's amazing, just after the 2001 blight in the currency, the rand came back quite strongly, and it weeded out a lot of kind of inefficient exporters and those exporters that were just relying on currency depreciation in years gone by had to find ways to remain competitive. And I think those people are probably still in the market and have, as you say, learned to kind of contend with a strong rand environment. So, the corporate South Africans, we mustn't underestimate that they are fairly adaptable, but obviously if rand remains at strong levels for a sustained period of time, then it's going to be problematic. Of course, we could also say that some of these corporates have possibly hedged their exposures when the currency was a lot weaker. Let's hope that was indeed the case, but those hedges can't last forever. If the rand remains strong for a protracted period of time, exports and South African growth will suffer.
Let's look at the PMI out of China. The official number at 52.9 in January from 53.9 in December. Inflationary concerns coming to the fore with those input prices. In South Africa, we're also expecting the PMI number out today. We're sitting at 51.7. Many are expecting a slight tick up to 52.
Yeah, I think you touched on a very important thing there about the inflation picking up in China. I think that's really a huge underlying theme here. We've seen it in Egypt. It's probably the underlying reason for the flare up there and the Middle East region more generally. And we're going to be watching that price component more and more closely, I think. Obviously the rand has been very strong, and it's curbed inflationary pressures from an import side. But the cost push pressures are coming through now. Oil prices are at these above $100 a barrel. We've got high food prices. All of that spells for an inflationary environment going forward. And that was inevitable given that interest rates globally have been so low. So although we are hoping to see an improvement in the manufacturing sector, we want to see growth that is real growth and not just adjusted for inflation, as you've seen, as you said, mentioned in China.